Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. This is the weekend edition. We've got a very special show for you today. On today's show, we're going to be replaying a conversation that I had with Adam Taggart on the Peak Prosperity YouTube channel. Peak Prosperity is an organization run by my good friends, Dr. Chris Martenson and Adam Taggart. And the Peak Prosperity movement has over 1 million followers. They're dedicated to helping people build resilience into their lives. Listen to my conversation with Adam Taggart.
Hello and welcome to Peak Prosperity. I'm Peak Prosperity co-founder Adam Taggart. And as usual, we are here to make sense of the markets and of money in general. This week, we want to talk about real estate. You know, when the topic of investing comes up, most people immediately think of the financial markets, right? Stocks, bonds, et cetera. But interestingly, the number one most preferred investment by Americans is real estate, and it's for compelling reasons. Real estate can produce inflation-adjusting income along with equity appreciation over time, while also enjoying tax advantages that stocks and bonds don't benefit from, which is why we're very fortunate today to be joined by Victor Menashe. Victor is a seasoned real estate investor who purchases and develops properties throughout the U.S. and Canada. In addition to his focus on producing returns for his investors, Victor is an educator who's passionate about helping regular folks understand how they can use the advantages of real estate to generate inflation-adjusting income streams. Victor, our paths tend to cross at least once or twice every year. COVID's kind of thrown a monkey wrench into that, but it's really nice to be able to connect with you live here, at least virtually. Great to see you again, and thank you so much for coming on the program.
It's great to be here again. Thanks for having me.
You're very welcome. Well, look, let's just jump right in here. Can you just give our viewers a quick background on the benefits of investing in real estate and the role that it can play in a diversified portfolio?
Absolutely. Let me start by making a bit of a distinction between the different forms of real estate. I want to separate what happens in the world of residential real estate versus the world of commercial real estate. There's so many different asset classes. We see things in the press about the risk of investing in real estate, and the long shadow and the memory of the post-2008 is probably still fresh in people's minds. So we want to make a bit of a distinction about what happens in the world of residential versus commercial. And if you think today we're in the COVID environment, there's certain asset classes, even in commercial, that are suffering. We think about hospitality, we think about office, we think about retail. All of those asset classes are a little bit discretionary, and therefore they're suffering. So when we tend to talk about real estate, our focus is on those classes of real estate that are essential, which means housing. People still need a place to live, but we're talking about commercial real estate, not residential, because the way commercial real estate gets valued is different than residential real estate. Residential real estate gets valued because maybe your spouse likes the way this place looks and they like the view and they're willing to pay more for that. Commercial real estate doesn't get valued that way. It gets valued as a financial asset, the same way that you would value a treasury bill or a stock or a bond. It's based on multiples of net income, and it's not speculation. So it's a very different way of looking at an investment. You got to look at these as you would look at any paper investment, except it happens to be a real asset.
Great, thanks for that. And you very rightly emphasized something that our friends Robert Helms and Russell Gray of the Real Estate Guys, they say that, don't think of real estate as an asset class. Think of it as many different types of asset classes because they all have their strengths, weaknesses. They perform differently in different market environments. All right, so you tend to invest more in commercial real estate, and you mentioned how commercial real estate is at least in theory, supposed to be valued on as the discounted flow of the income streams that it produces. You gave a little bit of nod to COVID, but right now we have an awful lot more people and more businesses that cannot afford the rents that they were paying before COVID came along. So, what's happening in the industry right now? Like how badly is it getting hit, and which parts of the industry seem to be doing better and which parts of the industry seem to be doing worse?
The two brightest lights in the industry right now, again, I'm speaking commercial, are industrial real estate, warehouses, refrigerator warehouses, anything like that, are experiencing tremendous demand, strong rent growth. You see fulfillment centers popping up all over the country. You see e-commerce looking for more space to replace the retail space that is shrinking. So that's certainly one asset class. It's not our focus. The second area that I would say is doing really well is multifamily. And that falls into two classes. First would be, the typical garden-style multifamily apartment complexes that you see all over the country. But there's an increasing asset class as well, which are almost like executive townhouses, but purpose-built for rentals. People like to live in a single-family home. They may not necessarily afford a single-family home, but they like something that lives like a house. So there are a lot of purpose-built communities coming together specifically as rental assets. Rather than just going out and buying a bunch of single-family homes and renting those, these are purpose-built communities. So we like those in general. And I would say those are the two areas that we would focus on in today's environment as doing the best. You talked a little bit about COVID. Rent collections in residential real estate are quite high. They're well into the 90s. It's a couple of percentage points off what it was compared with the pre-pandemic numbers, but we're not seeing the cataclysmic predictions that were made early in COVID about, people not paying rent. That we've not experienced that at all.
And I'm curious, how much of that do you think might be tied to the fiscal stimulus that has been, increasing people's unemployment benefits and sending checks in the mail and stuff like that? Is that allowing people to kind of continue to pay the previous market value rents? And if so, is there a concern that you might start seeing defaults once those checks end?
So it's a very good question. Certainly the amount of stimulus that's coming into the marketplace has created a little bit of an artificial environment. The moratorium on evictions has created an artificial environment as well. And having said that, all the noises out of Washington right now is they're not going to let the population flounder. Certainly the majority of the hardship that's being experienced in the COVID environment are in that tenant class. If you look at who's lost their jobs, it's people that are in hospitality, in restaurants, in retail, hourly paid workers, factory workers. It's not the hedge fund managers. They're gainfully employed, So it's really the folks that are kind of at the bottom of the economic ladder that have suffered the most. They've suffered disproportionately, and yet we're still seeing very strong collections in rent. So the only conclusion we can really draw is that stimulus is working.
Okay, great. And I'll get into in just a few minutes sort of what you think the key factors are to consider when investing in a certain property or property type. Just to give an example, that you can invest in multifamily, but then you got to determine where along the spectrum of multifamily do you want to play. And what we often hear from people is it's smart to play in sort of moderate properties or middle tier properties, because in a economic boom, you get people at the lower ends who are competing to get into the property as they become, more wealthy. And then in a recession, you have people from the higher end competing to come down in as they're downsizing, right? So that's sort of one example where if you have a good property, it can actually do well in different market cycles. But before we get there, just a quick question for you. For people that have not invested in real estate yet, but are sort of intrigued by the idea of it, can you just sort of give a minute on the benefits of doing so as an investor versus investing in stocks and bonds? Sort of why invest in real estate as a regular investor?
Well, certainly if anyone is listening to this, chances are that they've listened to the crash course or watched the crash course and understand the impact that inflation has over the long term. So I'll just give you a very simple example. Imagine for a moment that you bought a property that was, let's say, $1 million, and you put down, let's say, the minimum 20%. So you put down $200,000 and you borrowed $800,000 from the bank. So you've got that typical 80-20 loan to value, loan to cost ratio. And let's say that inflation's running a little bit higher than the government is projecting. Let's say inflation, just to keep the math simple, is running at 10%. So a year from now, that property, instead of being priced at $1 million, is priced at $1.1 million. I don't want to say it's worth $1.1 million because that gets us down a whole rabbit hole of philosophy, but it's priced at $1.1 million. Now, even if you made almost no principal pay down in that first year, you still roughly have $800,000 in debt, but your equity has grown from $200,000 to $300,000. Now, the mathematicians in the crowd are probably saying, well, wait a minute, Victor, that 300,000 is not quite worth 300,000 in last year's dollars. So it's worth now, let's say 10% less than that, it's worth 270. You've still made very, very good return on that equity investment just through that extra leverage. And that is the game. We talk about playing the game. And the question is, do you know the rules of the game? Most of the people are playing the game. They're out there on the field. They've got the ball in their hands. And this other team comes out, except they got helmets on and they've got padding. And you think you're out there playing rugby, but it's actually you're playing football. And you just don't know it. So you're not playing by the rules that the rest of the folks are playing by. And you're going to get clobbered because you don't know the rules. And if you thought for a second that the game was how do you win in an inflationary environment, you play the game very differently. And that's really the benefit that real estate gives you, especially with a modest amount of leverage. All of the benefit goes to the equity holder, and the depreciating asset is the loan. The depreciating asset is your savings in the bank account. What gets wiped out in inflation? People on fixed income, their buying power gets wiped out. Debt gets wiped out and savings get wiped out. So you want to play the game so that you're on the winning side of that trade. That's it. Nothing more complicated.
That's a great, I think, simplistic way to say it, Victor. So that is a great job. And just to emphasize your point there. So we've had a number of very august economic and financial thinkers on this program over the past couple of months, who have been saying that by their calculus, the odds of inflation have gone up pretty dramatically over the past year. No big surprise. I'm forgetting the exact number, but I just saw the stat that it was literally something, I think, nearing or in excess of $20 trillion that has been in stimulus that's been ushered throughout the world over the past year, if you add up all the different monetary and fiscal stimulus programs across all the major countries. I mean, it's just a massive wall of liquidity that's going into the market, and more dollars means more inflation. That actually is the textbook definition of inflation, is an increase in the money supply.
Right. But if you look at it even from a consumer price index perspective, I mean, all of the rhetoric around, for example, increasing the minimum wage, absolutely people are struggling, and getting the minimum wage up is going to benefit some people temporarily. But if someone is making $15 an hour right now and the minimum wage is now $15, guess what? That person's going to feel like they've moved backwards. So they're going to be going to their boss saying, you know what, I need $20 an hour now. And it's going to trickle through the economy. It's going to raise prices locally for anything that's manufactured locally. It's going to give advantage to those products that are imported, unless, of course, the dollar falls, which it probably will. But at the end of the day, that's all inflationary.
It is. And one thing that many people don't understand is programs that give money directly to households, they tend to be much more inflationary than the other types of stimulus, because that money gets spent immediately and increases the velocity of money in the system, which drives prices up. And I don't want to get too caught around that, but it's just an important thing to keep in mind. So, as you said, Victor, real estate is great because you have the leverage that debt gives you to be able to make the return that you calculated, right? Your example there was almost a 50% return in 1 year. And hey, that's not guaranteed, but you give an example of how that can happen, with the leverage of real estate. You talked about the income stream, that you get from real estate. And again, we call those inflation adjusting income streams. So like you said, a bond, you buy a bond, you lock in what you're going to get from that bond as an income stream, and that gets depreciated in purchasing power as inflation rises. But if you're charging rents adjust with inflation, right? And so, as somebody who's invested in a rental property, you're able to, basically move your prices up along with inflation. So you're sort of protecting that purchasing power. And again, another important thing about real estate is that that income stream over time, you can use to pay down the mortgage, pay down the debt you have on the property. But again, in a highly inflationary environment, inflation's doing a good job of reducing the cost of that debt to you along the way. So I just want folks to really understand that there are multiple advantages to investing in real estate that you don't necessarily get in the financial markets. The last thing I want to ask you about on this topic is real estate does enjoy certain tax benefits. Can you just talk about one or two of them so that people have a general sense of how real estate can differ from a paper asset like a stock?
Absolutely. So When you get income, net income from the property, it comes out in the form of a distribution. And you typically will also charge as an expense against the property depreciation. So that depreciation will vary from one year to the next. If you do something called cost segregation, which means that you're going to look at the property in its constituent parts, the roof is going to depreciate at a different rate than the refrigerator is going to depreciate at a different rate from your carpeting and so on, you can accelerate some of that depreciation. This is work that is done by the accounting team that's supporting the real estate investment business. What that does is it often creates a situation where when you add that depreciation expense that flows through alongside the income, you can often zero out that quote-unquote profit so that a lot of that cash flow comes out almost tax-free. That's one of the real benefits of real estate. It's one of those things that's not, we don't believe is going to be challenged with the new Biden administration. That's one of the principles of investing in real estate that's been around since the beginning of time. There are things that came into play under the 2017 Trump tax law that might disappear, like bonus depreciation, which really accelerated it into 1 year. That may disappear, but the basic concept of depreciation that's been around for a long time is still at play, and it allows you to pull a lot of that income out, that cash flow out, almost tax-free on an annual basis.
Great. And real quickly for folks, when Victor said it sort of zeroes out the income, you're actually still getting the income. You're getting the cash. It's an accounting adjustment. And so the depreciation is a paper expense, basically, you're taking that year. So you're still getting the cash, but from a taxation standpoint, the government's subtracting the depreciation from your taxable income. And as Victor said, it might say, oh, it looks like you actually made $0 this year, even though you got cash in the door.
Exactly.
All right.
Exactly.
So Victor, let's switch on quickly to, I'm not trying to give people a crash course in, the ins and outs of real estate investing here, because we just don't have the time, and you're doing great so far. But if you could, you mentioned that, residential real estate, multifamily real estate is, still an attractive asset class right now, given the current market dynamics. Can you just give folks a general sense of, when you look at a property, whether it's when you're going to buy or when you're going to build, what are the, kind of success factors that you most look for to determine whether it's going to be a good investment?
So let me put it from the perspective of someone evaluating an opportunity, not just something that we would evaluate, but let's say someone puts an executive summary in front of you. This is what you should look at. You should look at three things. Number one, you should be looking at the submarket. And when I say that, I mean that real estate is hyper-local. If you pick any city, let's say Austin, Texas, the west side and the east side are dramatically different. The north and the south are dramatically different. You want to really be looking at it almost by neighborhood basis, so that you understand what's happening in that neighborhood in terms of rents and all of the rest. So you want to look at that submarket. What you're looking for is influx of population, influx of jobs. I don't ever want to be in a shrinking market. I will not, and this is just Victor's philosophy, I will not invest in Detroit. Nothing wrong with Detroit, but their population has cut in half over the last 30, 40 years. There's a reason you can buy houses for under $30,000. It's because there's more supply than demand. You want that supply-demand imbalance where there's more demand than supply, and you want to see that imbalance persist for a good long time. So I want that kind of upward pressure on prices. I want to see that upward pressure on rent, and I want to see that influx of population. So that's paramount, number one. Number two, you want to look at who the operator is. What's their track record? You don't want to be necessarily investing with the two guys in a pickup truck class of operator. You want to be looking at the folks that are established, that are really investment grade operators that have a strong track record. And then number three, you want to look at the specifics of the deal, which means you want to be looking at the multiples, and are they conservatively underwritten compared to the rest of the marketplace. So you actually want to look at that market study that comes along with the executive summary. I know it's a lot of pages, but you want to look at it and see that it's been underwritten conservatively. No different than you would for a stock or a bond. You wouldn't want to buy a stock that's trading at 50 times earnings, all of the things being equal, if the rest of the market is trading at 15 times earnings. You don't want to overpay for something. So I would look at those three things.
Okay, great. And you're really you're talking about an approach that I was just about to ask you about, which is uh, syndication, or basically buying into a deal. So people can invest in real estate directly if they want to. You can buy a building and become a landlord, right, and go out and find tenants for it and do all the property management and all that stuff. There's a lot that goes with that. That's not for everybody, and it can be costly to come up the learning curve there. Also, you're very limited by how much capital you have to invest. In other words, if you've got $20,000, you're not going to be buying a hospital and renting it out to a hospital management group, right? But with syndication, there are people out there like Victor and other people in his industry who they amass the capital from investors. They put together an offering and they say, we're going to buy this building, this apartment building. It might have hundreds of rooms in it, or we're going to buy or build this commercial property or hospital, or whatever it is, or sometimes you even develop them on your own too. And what that does is it gives people the ability to basically ride the coattails of an expert real estate investor, right? So if you don't have a lot of experience, you can get in a deal that's being run by somebody with a lot of experience. You can get into deals, again, that you couldn't otherwise get in on your own because the properties are just much bigger properties, much more expensive. And then third, you don't have to learn the ropes the hard way by getting calls at 2 a.m. because the plumbing broke and whatnot. Maybe there's not much more to say about syndicates than what I just rattled off there, but if you've got anything to say, please do, because I think a lot of people watching here may not actually know that model exists and may find that more sort of, it doesn't have to be entirely passive, but that sort of much more passive way of investing in real estate attractive, or at least attractive as a first step.
I would make the distinction. There's a lot of people out there watching TV shows of flipping houses and all of that sort of thing. And quite frankly, that's not investing. That's a job. Money comes in one of three ways. It comes either as earned income, as residual income, or capital gains. Or maybe the fourth one might be a government check. But, it's either earned income, residual income, or capital gains, one of those three. Flipping houses is not real estate investing. That's manufacturing. Your inventory is all the materials, including the house that you just bought, that you're going to go and improve. That's a manufacturing business. And so it's a very active business. If you go and spend 3 months on the beach, everything comes to a stop. That's an active business. And even owning and managing an apartment complex, if you have a 250-unit apartment complex, that's an active business too. It's not a passive business. You can invest passively in that active business and you can get residual income from that investment. At that point, it's an investment. Anything less than that, if you are actively involved, well, that's just another job by a different definition. So you want to make that distinction. If you think about where most of the wealth in the world's been created, it's been through some combination of residual income and capital gains. It's almost never been through that earned income approach.
All right, very well said. So, all right, well, as you wrap up here, for at least this first conversation, Victor, it's such a big topic. I'd love to have you on again to dig a little bit more deeply into it over time. But real estate it's got a lot of advantages that we talked about. It is much less liquid than, the common stock or bond or whatnot,
Correct.
Right? You can't just, and also too, it generally requires a larger capital commitment, right? You can't put $5 into a property, and you can't sell it, in the next minute if you decide you want to, right? So if there's anything about those, sort of the eyes wide open, things you'd want folks who are considering investing in real estate to know, please state them. But in answering that question, I would assume, and I don't want to put words in your mouth, but after I'm done talking with you, I'm going to talk with the lead partners from New Harbor Financial who are on this program every week, who are financial advisors. I would imagine that you would say, before making a real estate investment, especially if you're relatively new to it, you should work with the, under the counsel of your financial advisor to make sure that you're answering, these important questions correctly. How much should I put in? How should I fund it? Should it be just straight cash? Could it come out of a retirement account? That type of stuff. So I would assume that you would say, look, it's a big decision. Take it into account with your full financial situation and listen to your financial advisor. But if you disagree, let me know.
No, I think that's right. I know Mike and John from New Harbor, and they're not like your typical financial advisors. A lot of them are, I'll say, glorified salespeople. If they don't collect a commission on what they're selling you, they're not going to recommend it. So there's a lot of financial advisors out there that are basically just selling product that they've been told to sell. I don't think New Harbor are like that. They're really fiduciaries and looking out for investors' best interest first and foremost. So first thing is make sure that you're working with the right kind of financial advisor, not just someone who's a glorified salesperson. Because if they're not going to make any money off of recommending a real estate investment, they're not going to recommend it. It's that simple. I think it's a part of your investment strategy, part of your investment portfolio. I wouldn't necessarily make it everything, but it's a fantastic way of getting an inflation-adjusted, risk-adjusted return on your money for the long term. You're right; it is not as liquid as say a stock that you can sell in the next 3 minutes. But it's if your aim is long-term appreciation, if it's long-term wealth protection, in my view, this is what I do day in, day out. I can't think of anything better.
All right. Well, thanks so much, Victor. I'm going to give one shameless plug for Peak Prosperity's 6-episode, 12-hour-long webinar series in real estate investing, how to invest in real estate for safety and profit, which Russell Gray and Robert Helms, who I mentioned earlier, who are really good colleagues of Victor's, help put together for us. But we've just scratched the surface of the surface of the surface of the iceberg in this discussion. And if you want to delve more deeply, the first 2 hours of that video webinar series are completely free to watch. So I'll put the URL up here. And if you're interested, go watch that first episode. And if you like what you see, keep digging in there. Now, Victor, thank you so much for sharing so much of your time. And I think you did a phenomenal job of taking what can be, somewhat of a foreign, complicated topic to people and making it really understandable. So if people have been inspired, if they want to learn more, if they want to follow you and your work, maybe learn about some of the properties that you and your firm have coming up in the pipeline, where should they go?
Well, they can connect with me directly at my website at victorjm.com, or if they just want to learn more over a period of time, I'm the host of the Real Estate Espresso podcast. It's like the Italian coffee. It's a daily show 7 days a week, and it's a short-form show, 5 minutes, just me on the weekdays, and we have some amazing guests on the weekends, including yourself. You've been a past guest a couple of times, Adam. So the Real Estate Espresso podcast would love to connect with you that way as well.
Great. And highly recommend, if you're kind of interested in this topic and want to learn more about it, beginning to listen to that podcast is a great way to get onboarded very quickly. Victor's a phenomenal host and very gracious, as I'm sure you've already realized by listening to him. Victor, thanks so much. We'll let you go here and get back to your important work. But again, thanks so much for the time. And I look forward to having you back on later in 2021.
Thank you so much, Adam.
All right. John and Mike, another week, another phenomenal guest.
Wow, I love speaking with Adam. He's been a guest a few times on this podcast, as has his partner, Dr. Chris Martenson. Chris holds a PhD in pathology from Duke University, and he was one of the very first people to sound the alarm about COVID-19 back in January of last year. He's been consistently weeks or months ahead in his reporting compared with the information coming out of government agencies. Adam, similarly, has been active in seeking out analysts in the financial markets to understand what's happening beneath the surface that we see reported in the mainstream financial press. Adam and Chris both continue to make fundamentally life-changing contributions to the world of both business resilience and human resilience. When we talk about capital, people often just focus on what's in your bank account. Adam and Chris believe there are 8 forms of capital that make up your life, and if you only focus on a few of them, you're probably not going to make it. Definitely, you're going to want to check them out at peakprosperity.com. That's peakprosperity.com. And for the listeners at home, have an awesome rest of your weekend. Go make some great things happen. I'll talk to you again tomorrow.